Packaged foods company ConAgra just reported earnings and the results were quite disappointing. And we did see some institutional options flow in there. We're going to be talking about the flow that we saw, how I would change the trade that the institution did, and what some of the implications are today on open interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. For those of you who follow packaged food companies, these would be companies like Campbell's and Lamb Weston. That's more of a sort of an institutional seller, ConAgra and so on. ConAgra just reported earnings. These are not companies that we would typically associate with a significant amount of volatility, and yet ConAgra dropped about 10% today. I'm not exactly sure where it closed. We can check on that in just a second, but it was down about 10% on the heels of disappointing earnings. I talked a little bit about this on Market Navigator, middle of the day on CNBC today, but I thought we might be able to get into it in a little bit more detail and also take a look at one of the trades that I saw that sort of prompted the, my inquiry into it and my thinking on the valuation as it currently stands. So first things first, ConAgra traded about almost 18,000 put contracts today, and it typically trades just over 1,000. The 20-day average volume is 1,047 put contracts, and the bulk of that volume was concentrated in the January 30 puts and the December 30 puts, and both of those traded just under 3,000 contracts each. And when I took a look at them, and we can do this together if we like, because for those of you who are trying to follow along and are sometimes interested in these things, when I see things like this, if you're looking at my screen, where the volumes are very similar to one another, and they're not in the front month. So, and this is again not something that trades a whole lot of options volume. Traded 31,000 contracts in total today. Most of that was on the put side. And you start seeing something like this, where you're seeing December and January, out month contracts, same strike, same quantities. Immediately, I'm going to suspect that these trades are in some way related to each other. And we can confirm that by just taking a look at time and sales. Now, you may have a mechanism on your brokerage platform that allows you to screen through unusual trades very easily, but if you don't and you're looking at time and sales and you have access to something like what I'm looking at here, where you can just basically see the prints, it's going to tell you a couple of things. It's going to tell you how many contracts traded, at what price, the time that they traded, and then importantly over here on the Bloomberg terminal, as it happens, this is just known as a condition code. It will let you know what's going on here, and sometimes you'll see a condition code that says ET. That just means an electronic trade. If it's a floor cross, it will let you know that. Different exchanges have different condition codes, but you can go through these and see in many cases that they are effectively meaning the same thing. So down here we can see at 323 this 20 lot went off. It has condition code MA. What does that stand for? Multiple leg auction. You go over here, you see ME, multi-leg automatic execution. So on the auction side, that doesn't mean that it wasn't electronic. There can be an electronic auction as well. So someone can put a complex order into an electronic order book, and one of the exchange's price improvement mechanisms can step in and improve the price slightly one side or the other, if it's a market order or a marketable limit order. So But the short version of this is that we can see, regardless of which one of these condition codes that we're looking at, that these trades are, for the most part, multi-leg executions. And if I go back, and we could pick any one of those times and pick the other contract, what we're going to see is the exact same thing, same time, right? So multiple leg executions taking place at the same time. These are related to each other. What is going on here? What is this institution trying to do? What are they trying to play for? And it's actually a trade, I believe, that is probably very similar to one that we often talk about here, which is a calendar spread. I believe selling December 30 puts and buying January 30 puts. Why would you choose that? Well, for one thing, the implied volatility between those two contracts is not that great. We can see that by taking a look at the term structure. Now, by the end of the day, it may have steepened up a little bit. I was only looking at this in the morning. So here we can see December trading about 20.5 vol. January is trading about 22.25 vol. So, about 2 clicks of vol difference. What is the distinction between these two contracts? Well, here we are, second day of October. You can probably guess. Publicly traded companies report their earnings approximately every 90 days or so. The January options are going to capture the next earnings release. The December options are not. So, somebody who wants to own some downside in ConAgra that captures the next earnings event can significantly reduce the cost of that if they don't think that the stock is going to move that much between now and the next earnings release date. So I think the cost of that calendar was about 30 cents. I'm just going to pull up Options Play very quickly here so we can take a look at one of the alternatives that I was thinking about. And that is that, and actually before we get to the alternative, let me just point out one other quick thing here. And this is just sort of a general comment about gaps, price jumps, like the one that we're seeing here. One of the things that I often hear people saying is, oh, should I, the company's trading very cheap now. And if you're looking at this on a trailing basis, even a forward basis, company's trading at a very cheap multiple. Should I jump in and buy the stock here? And there's really two sort of outcomes that we will typically see when you get this kind of price action on news. So we got earnings out. Earnings clearly disappointed the street, and the price gap's lower. What are the two outcomes? So oftentimes when news comes out outside of regular trading hours, you'll see a gap in one direction. And then when regular trading resumes, that price jump turns out to be either more muted or actually ends up being reversed. So somehow something comes out, it disappoints the street, and then all of a sudden regular trading hours come out and the stock is a little changed, or maybe even it has a strong reversal and trades higher. What could be the potential causes of that, and why is it that traders frequently talk about things like the 3-day rule? I don't know how often I have mentioned it on CNBC, but I think Steve Grasso talks about it quite a bit. I think Karen Feinerman has brought it up once or twice, and of course some just mentioning colleagues from CNBC, but it's not uncommon to hear this. The reason is that oftentimes what we call real money accounts, and in the universe of real money accounts, what we're talking about are typically long-only managers that have very sizable positions. What would be examples of real money accounts? Well, the biggest would be something like a sovereign wealth fund. That would, in those cases, you can have a sovereign wealth fund's got $1 trillion in it. Mutual fund companies, T. Rowe Price, Alliance, companies like that definitely qualify. Insurance companies, pensions, endowments, and trusts, that sort of thing. So we call these real money accounts, number one, they're real money accounts because they're typically unlevered. They take long-term positions, more often than not, long only as well, unlike faster accounts. So we'll just take a quick peek at who the holders are here, the largest holders, and try to make a distinction between some of these and think about it. So first things first. Vanguard, BlackRock, State Street. So some of these, so State Street is a custody bank, a custodian bank, and Vanguard's the big index provider, as is BlackRock. So you have index funds and you have ETFs. These don't necessarily qualify in that category that I'm talking about. And the reason that they do not is because the distinction that you make between these accounts and something like T Rowe is there isn't a fund manager who's making a determination. If somebody starts buying an ETF, a BlackRock ETF, or one of the ETFs that are custodied at State Street, what happens with the underlying shares, that rebalancing is not discretionary by the manager, right? Now, I've actually managed an ETF. Ours was discretionary. But in general, most of these are not. That is to say that they're not actively managed. There isn't a portfolio manager who's sitting in there saying, okay, I'm going to buy this or sell that. The biggest of these would be SPY. There's not somebody who's making a conscious decision from one day to the next that they're going to buy one stock and sell another. The construct is dictated by the index itself, and that gets rebalanced when it does. On the other hand, something like T Rowe or American Century, these kinds of managers are active managers. There are portfolio managers making conscious decisions about whether they're going to buy or sell a stock. And they manage assets substantial enough that when they decide that they're going to do that, it is going to have a meaningful impact on the share price. And if we take a look here, we can see in T. Rowe Price's case, they were one of the largest shareholders, as we can see. They've sold 6.7 million shares just in the second quarter of this year. American Century, one of these other ones, yeah, American Century sold 2 million. So this BlackRock, that's passive, but the T. Rowe and American Century, that's active. And so the reason that you have these multi-day rules is because oftentimes what you're trying to establish is whether discretionary managers are making a determination about whether they're going to continue to hold shares, whether they're going to blow them out, whether they're going to add, and so on. So this is not exactly a stock that was doing particularly well even to begin with, as many of the companies in this space have not. But we can sort of see that there has been some activity amongst longer term holders that was not particularly bullish. So having checked on that, we can see that if you were interested in making a bearish bet here, and you can see that this essentially has erased all of the gains for the year. The stock's essentially now flat on the year net of this. So we know that there's going to be another earnings result right over here in January. And actually the estimate right now is the 2nd. I don't know whether that's accurate or not, but it doesn't have to be that precise because it can be off by 1 week or another in either direction. And I don't think it's going to be early because there's probably going to be at least 3 months between the current earnings and the next one. The January expiration is definitely going to capture it, right? So there's quite a lot of wiggle room in there. So by doing that trade and spending about 30 cents, which is about 1% of the current underlying, and figuring that the stock is probably going to be range bound between now and then that would help justify that trade. So I thought I had already pulled up options play. We're just going to illustrate this very quickly and then talk about the minor tweak that I would make to the trade. Whoever the institutional trader is that put this trade on, they didn't happen to call me about it. No reason why they would, but I think they could have done this a little bit better. Let's just take a look at the trade that they put on first. So they were both puts. They bought the January 30s and sold the Decembers. Nothing really wrong with that trade necessarily, but you get a trade profile that looks like this. Okay, so it's going to be range bound is where you're going to see those profits. The break evens we can see are in a relatively narrow band over here. And one can imagine that if you held some portion of the stock and you were concerned that the next earnings might be similarly disappointing, this could materially reduce your cost of owning that insurance for that event, with the expectation that the volatility for the stock in the intervening period is probably going to be more muted, which is generally going to be true. So how would I have tweaked this? This is a stock that, at this point it's trading at quite a low multiple. We're going to get to that in just a second. And you don't have to depending on whether you have this position on or not. But my thinking is that if you do get some continued real account selling, there is some possibility that the stock could drift a little bit lower, but you could actually put the trade on here for no carry, and no matter how high it goes to the upside, no loss. If it drifts a little bit lower, you could see some profits. If it basically goes sideways and you happen to own the stock, you're going to end up owning that January insurance. Admittedly, significantly lower than the current stock price. I mean, it's $2 lower, so you're talking about 7% of the current stock price or so. But I kind of like that trade setup a little bit better. If you happen to own ConAgra, got a little bit shell-shocked by what happened today, rather than spending the 1% to put on that calendar and have the possibility of losing in both directions, I think it would be more advisable to look for a diagonal put spread. Now, normally when I do diagonals, what do? I usually buy the higher strike option, longer dated, and sell a more out-of-the-money one. This is not a really high-vol name. But this would be an example, and this is the reason I thought I'd bring this up, of where I might actually trade it the other way. So something to think about there. Something else to think about, which I was sort of thinking about, I don't know that I've talked about this very much, but when it comes to valuations for companies, sometimes I like to go back quite some distance in time. And the reason for this, particularly if we're looking back over the pandemic period, there have been a number of companies whose operating results were unusual, in many cases deservedly so, but unusual during the pandemic period. ConAgra is one of these cases. So you'll notice that the trailing 12-month net income margin is about 12%, and the forecast is about 10%. Now, if you go further back in time to prior to the pandemic period, and I don't know if you can see this very clearly, I'm going to show this with my cursor and just, so for example, 12-month period ended end of May 2023, the net income margin was 16%. And this, why I'm pointing that out, 11.5% here in 2021. You'll also notice, this is not a fast-growing company, but you will also notice that in 2020, particularly in this last quarter, there was a big uptick in their top line. And a lot of that had to do with, what was going on during the pandemic. Packaged foods, people are locked in their homes, saw a big boost. We saw a lot of price dislocation. And some of that price dislocation, created more volatility, and more volatility on the margin side than you would experience under any other or normal conditions, if you will. We had logistics problems. The prices of foods, which are up significantly over the period, were rising, and packaged food prices rose, but they didn't necessarily rise in lockstep with the input cost, because you can imagine that if you're making packaged goods, the commodity prices that you paid for those inputs may have been much lower. So you're going to see a margin expansion take place then. You're buying food, you're turning it into processed food, you're putting it into packaging, and then the pandemic breaks out before you sell it. All the prices for a lot of things are going up, including your packaged goods, and you create this spread. So what I was interested in doing was actually taking a look at what the historical margins for this business, and other businesses, by the way, other packaged food businesses, was going further back in time. And what I found was that in general, the kinds of margins that people are forecasting for the next couple of years were actually at the upper end of the historical range. So you cannot look back at the margins that we have seen since February of 2020 and consider that to be representative for what you are going to be getting in the next 4 or 5 years hence. In other words, take and smooth something from what you think is a representative period and then apply that going forward. And what I ended up with is a number that's probably, you can see here, this was 2015 was less than 6%, 2016, 6.5%. We had these 2 years were just under 11, 2019 was 9.7. Now you combine all of this. Now this is not the kind of company we would typically be talking about because in many ways it doesn't necessarily qualify for something that I would think of as a core constituent for a long-only book. And the reason is that we are not seeing top-line growth here. We're actually seeing negative top-line growth. And on an inflation-adjusted basis, of course, it's worse than this. But, of course, we're looking at it, number one, because the stock moved, because it's had unusual options volume, and because it does appear to be trading at a very low multiple. So if you take a look at 2026 fiscal year, so their fiscal year ends at the end of May, so the street is looking for $2.70 a share. That gets us to just over, call it 11 times earnings, right? So 270 times 11, that's going to get you to 29.70. The stock's trading about 30. But when I was looking at this, I was thinking, okay, well, let's handicap that a bit and take a look at the margins that the company was experiencing prior to the pandemic. Figure that it's 100 basis points too rich. Round down, so take a revenue estimate of about 12 billion. Now we're going to look at net income in the $1.2 billion range. That's going to get you down to an EPS, give or take, of about $2.50 a share or less. Even so, that's a pretty cheap multiple. We're talking about less than 15 times earnings or thereabouts. So, if you're interested in owning the stock, or if you own it, then consider putting on that diagonal spread as an alternative to the institutional trade that you may have already observed as a way to hedge it. And I'm just going to pull this up. So this is the dividend history for the stock. This would be a reason why many of you may own it. For those of you who are looking for dividend yields, and I know that some of you do and should, then this would be that reason. And by the way, this does have quite a high dividend yield. So not a grower, really shrinking in real terms. As you take a look at this valuation, and this is really true in many cases. So you look at a company like this and you say, how on earth could this thing be trading 10 times earnings or 11 times earnings? And what you should be doing is, keep taking a step further and further back until you start to see data come in that helps explain what you're looking at. If you thought that the margins were going to go back to 16% because you noticed that that's where they were 24 months ago, you'd have a very distorted view of what this company is worth and where it should be trading. So I would offer that as something. And now there's one other thing I figured I would just mention this. I was actually looking for it in the earnings call transcript because I saw it reported, but I couldn't find the language. So I'm going to I'm going to share this. People will say, he said this without evidence. So the only evidence I have that this was said is that I saw other people report that it was said. But this is what I read that was reported. What was reported was that one of the market dynamics that management has referred to, and by the way, if you don't know what brands ConAgra sells, I think they have Bird's Eye frozen vegetables, Slim Jim, Hebrew National hot dogs. By the way, their Hebrew National plant was shut down for a period of time, which reduced the number of hot dogs that they were able to produce and sell. But one of the things that management supposedly blamed for their operating results was that consumers had been shifting down to a lower, as people get pressured by higher prices, they shift the products that they consume. So, this is actually used when they do inflation calculations. Beef becomes too expensive, they make assumptions that maybe consumers switch to chicken because it hasn't appreciated in price quite as much or been inflated in price by quite as much. The observation that they were making about consumer behavior I thought was extremely alarming, but one of the things that was cited was that people were purchasing less fresh produce, less frozen produce, and purchasing more canned produce in an effort to save money. And honestly, as I read that, yeah, my heart sank, because we have already seen, we've heard it from McDonald's, we have heard it from Dollar General, that the lower end consumer is suffering. Not that we would not have known that already by looking at consumer savings rates, increased consumer debt levels, and other things. But the impact over the last 2 or 3 years of inflation, particularly in food, has really been profound. And what occurred to me was, number one, we should not expect companies that sell product to that consumer base to be out of the woods in that area anytime soon. Just because we're getting too many data points that suggest it. And it's also interesting because for those of us who are wondering, what is the true state of, the lower end consumer, we don't need to speculate either about its cause or its effects, because the companies that cater to that demographic, their results will tell you what you need to know. It's the difference between being a theoretical physicist and operating in the lab. We get to see what's actually happening. And it's not a good message. The other thing I would add about that, and this isn't so much, it may come across as political, it's not intended to be, but it has important implications. And that is that if you wonder where economic populism originates, it generally originates with legitimate economic hardship. So you're only going to create more fuel in that fire. Whichever political direction that populism swings in, that's a different issue. But you should anticipate it. And anticipating that also means that as you look out in time through this election cycle and into the next year, however it turns out, bear in mind that there is a growing demographic whose day-to-day life is such that they're probably going to be more insistent on some form of political change. Whoever they happen to blame, again, that's a different matter. But this is real, and we are seeing it. Okay. So with that, I'm going to try to answer some questions and be quicker than I have been in the past, because I tend to get into it quite a lot. So FinWest, hi Mike, I'm home in Asia once again, getting adjusted to the time zone change. Appreciate your Nike discussion in an earlier session. Yes, Nike. So remember, we talked about that on Monday, and the thing we were discussing was that Elliott Hill, I think he can do a lot of things to try to turn this failing story around, which is that they are failing on the product side. We know that they're failing on the product side because their top line revenues have been declining even as other athleisure companies have continued to grow. So they reported their earnings, and I find this rather interesting because we actually talked about this. There was no chance that the numbers were going to be good because Elliott Hill doesn't even take over until the 14th. So 12 more days till he becomes the CEO of the company, and even once he does, shifting the company's focus from the DTC, e-commerce, Donahoe sort of objective and focus of the business back to product is going to take some time. And we should expect that, which is the reason why I said if you're going to make a bullish bet, longer dated calls and sell near dated calls against it, and I continue to advocate for that. Although I'm rather surprised that it came out as negative as this. But, there's a reason. Turning the ship around is not going to be immediate. Okay. So, Southpaw 96 says, hi Mike, can I get your thoughts on ETF option strategies? Example, TSLY, which is the Tesla options-based ETF, NVDY. You have NFLX, which is Netflix regular ticker. So I'm assuming that what you're actually referring to is NFLY. Is that correct? Yeah, that's the YieldMax one. So these are the YieldMax ETFs. I hope I'm sharing that with you guys right now. They have a plethora to choose from, and some have very high 30-day yields. Thanks. Okay. So, I don't have an issue with these options-based ETFs per se. I guess the question I would ask is, why not do a trade yourself, right? So you can have more, you'll have a better sense of the day-to-day characteristics doing the trade yourself, and you'll know what its risk characteristics are. This is fine. I mean, it's a set and forget type of an approach. So, if you take a look at this, I'm comparing, for example, Netflix to NFLY. So here we have Netflix equity in, can I highlight that? There we are. So highlighted in blue here at the moment, if I can get over it so it just gets a little brighter. There we go. So that's Netflix. And NFLY is down here. Now, you will notice this is going sideways. Does that mean it's grossly underperforming? Well, on a price basis, perhaps. That is not to say, though, that the total return, is necessarily so bad, right? So we're going to compare that. So if you want to set and forget kind of a return situation, you can do this. So you'll notice that the price action on NFLY, using the Netflix comparator, is essentially the stocks, actually it's down slightly over the course of, what's the period I'm looking at here, from August of 2023 to, why don't we just take a look at it year to date. So year to date, you can see that NFLY is actually lower, but your total return is not so bad. It's an income generating tool, and you can see that your total return for the year is just on 37%, which is pretty good. But whether that's appropriate for you, bear in mind a couple of things. Number one, you can probably replicate some of this strategy yourself by either owning the stock and trading options around it, or trading some combination of options, such that you're collecting yield, which is the objective of these. But the other thing I would point out is that if you are doing this trade in a taxable account, the after-tax total return at the end of this year for the YieldMax options-based ETF is going to be clipped by taxes in a way that holding the underlying shares would not be. And so that gap, which is about 9%, as we can see here in this case, would actually be greater. Now, for many people, the set and forget mode of yield enhancement or yield collection, or just looking for strategies so that you can collect yield, is valuable. And I'm not going to discount that entirely. Why don't we compare another one and just sort of see how that. So we'll look at TSLY versus Tesla. Again, year to date. So flat, and TSLY is down slightly. I wonder why that is. Comes as a little bit of a surprise to me. I actually would have anticipated that it would be about even with. Yeah. Yeah, I mean, obviously we got the delivery numbers as Brad in my ear, one of the producers of the program, is telling me, obviously Tesla had a decline today. But generally speaking, when you have, if you consider this, right? Consider the behavior between two bonds, where one's a 0 That is to say that all of the interest accrues and is paid at the end along with the principal, versus a conventional bond that's paying regular coupons. You would expect that the volatility of your total returns with the bond that's making regular coupon payments would be less, and that's not the case here. Why that's not the case, I would probably need to delve into that a little bit more. Let's take a look at another one. When we look at NVIDIA versus NVIDIA, so here total return of 91% versus 140% for the common. And let's take a look at this. What we should be looking at as well is the actual volatility. So usually when you're selling premium and you're collecting a yield over time, the volatility of that instrument should, in theory, be slightly lower. And so that's something to keep an eye out for. But we're going to take a look at this. I'm just going to take a look at the 30-day realized volatility. Or actually, I think this is based on calendar days. So we're going to just go 22. That's the approximate. And I'm going to compare these two. Because what your hope is, if you're going to do one of these strategies, if they are doing it well, at least as well as you might be able to do it yourself, is that the volatility should be slightly lower. And yeah, it appears to be. So on price gaps, unsurprisingly, it's not dissimilar. But in the general case, otherwise, it appears to be a little bit lower. Okay, so yeah, I mean, I guess these things are okay. I'm not recommending them. I don't know that I've ever recommended them. But, every investor has different needs, and if yield is what you're after. But here's the other observation I would just quickly make. Notice that the yield you're getting is still very correlated with the price action. So you don't just get to say, oh, well, these things, they trade a lot of options, they're very deep in liquid options markets, and they're relatively volatile, so the premiums are great, and therefore I'm milking out some arbitrage because I'm selling premium on these more volatile names. You can see that the volatility is, as it should be, a little bit lower, but not much, right? So you're still taking risk very similar to that of trading the underlying equity. Okay? So, all right, let's move on. Okay. Oh, and you actually follow up here. I believe the strategy is buying at the money calls, selling 1 to 6 month at the money puts, and then short calls with a month to less. Okay, so yeah, so this is, yeah, I'm in a buy right? If you own the stock and you sold short-dated calls. So just a quick point. We've talked about this before, and I'm going to illustrate it because if there's anybody who has not seen this before, I just want to make a quick point. Oh, by the way, here, are we sharing my screen? I don't think I shared this already, but this was on the front page of the Financial Times, and I wanted to mention it. Not really apropos of nothing, let's say, other than just thinking about AI. But OpenAI just got a big SoftBank investment. I think it was like $500 million on a very chunky valuation. But one of the things that came out of that was that Sam Altman was asking any backers of OpenAI not to support or invest in any competing AI startups. And first of all, that's fairly audacious. And secondly, quite alarming. So I sent out a tweet. If anybody follows it, I talked about the Infinity Stones and Thanos, wanting all of them. Not a healthy recipe. So Sam Altman's not calling on me to make a $500 million investment into OpenAI, but I can tell you that if I was going to make any investment, I would probably, if my hope for a better outcome for the world was in any way related to the way I deployed that capital, I would, based on that comment alone, have to invest it somewhere other than OpenAI, despite the fact that I'm really impressed with them. I don't think that's what any of us want, is for one group of organic intelligence to be unilaterally in charge of the predominant artificial intelligence. Doesn't seem advisable in terms of best outcomes. Okay, so let's just quickly talk about these synthetics. So I'm just going to use Tesla as the example. How you construct a synthetic covered call in the way that they propose. So the first thing I want to do is, how do you construct synthetic stock using options? And that is to buy a call and sell a put of the same strike and expiration. You create the stock synthetically. And that may not be intuitive, so I'm simply going to demonstrate it so that you can see what I'm talking about. We might as well choose a strike that is close to where the stock is now, 250. So buy a call, sell a put of the same strike and expiration. And what do you get? Synthetic stock. Why is this? If this makes no sense to you intuitively, so you can see this is stock, all right, and this is synthetic stock. Same thing. Why is this true? Because if you are long the 250 strike call, at expiration, all else equal, if the stock is above 250, you will buy it at 250. Right? Because you're going to exercise your long call. It'll automatically be exercised if it's at least a penny in the money. So from 250 spot 01 and up, you will own the stock at 250. What happens if the stock is below 250 at expiration? You are short a put. The put will be automatically assigned, and you will be forced to buy the stock at 250, the strike of your short put. And that will automatically take place if the stock is 249.99 or below. So the only question about whether or not you would own the stock is if it lands directly at 250 at expiration, because then neither the call or the put would be exercised automatically. Although if you're long the call, you could elect to exercise it, and if you were short the put, the holder of the put might elect to exercise it. But in effect, you are synthetically just getting long the stock. It's kind of like a forward contract. And that's going to encapsulate cost of carry issues, which we've previously discussed. So if there's a dividend, not applicable here. The margin requirement for the options structure relative to actually funding fully paid shares, so on. But effectively, it's a synthetic. So if you wanted to create a buy right, you could take these structures. So I can take my long stock and say, all right, well, I want to sell a call against it, and I will do something short dated like the October 250s, or we'll go up a little bit here, 255s. So now I get a structure like this. That's a buy right, or a covered call, long stock, short call. And if I take this other structure and I do the exact same thing, I add a short call, October 255s, lo and behold, it's exactly the same. Not exactly the same because of those cost of carry issues and so on, but it's effectively the same thing. So that's what these things are doing. That's what these ETFs are doing. And the question is, why aren't you doing it then? Right? Because you can. And you could also do it if and when and as you thought it was appropriate to do so. And reasons why you might elect to do that could include things like earnings. So you might say to yourself, well, wait a minute, I know, or at least Mike or somebody else, or perhaps ORATS has told me that stocks are more volatile around earnings or other results, like the results that we got today on unit sales at Tesla, on their deliveries. Maybe I don't want to be short premium in that time frame. Maybe I'd rather, maybe I was sitting here and I was looking at it and I said, you know what? Take a look at this. The stock topped out right around here, back here in October of last year, again in December, again in July, just doesn't seem to be able to break through. So maybe yesterday you're saying, I don't want to be in a covered call. Maybe what I would rather is own my stock and sell a covered call and finance a downside put spread, right? So that would instead look something like, you could take this strategy and say, all right, I'm going to sell that upside call, but I'm going to buy a put spread to help insure my position, using October expiration just for the heck of it. So something like this, right? Or maybe you can go a little bit lower, 235, right? So I get a strategy that looks a little bit like this. Gives me a little bit of a buffer to the downside. So for those of you who are watching, and you obviously are at least somewhat conversant with options, or chances are you wouldn't be listening to me now, or you're trying to learn about them and figure out why maybe you'd want to do it yourself than have somebody else do it, is that you can do these kinds of things. You can decide that going into their sales result, maybe a covered call, which is a synthetic short put, isn't the thing that I want. So there you go. Okay. Moving on. And yeah, and as Southpaw mentions, and also T-bills 6 months to 2 years. So they have a cash balance because they're trading the synthetic, and so they're going to collect some interest. This is why the cost of carry plays into it. They're going to be collecting some money on the short balance and so on. Nike down almost 7% on earnings today, assuming that the Monday 90, October 95 short call is now only 5 cents. Yes, so yeah, that's a good idea. You are right, of course. And I don't know, did I say January? I may have said January. In another context, I think I wrote an article about it. I was also looking out to March. But yes, the short call side, you just cover this thing. For the nickel, you cover it. And you can roll that down into whatever you like and end up in a diagonal if you so choose. Let's take a look at what that diagonal might look like. Again, this company is not going to be reporting anything really material. It's not to say that there isn't anything happening, because we already talked about the fact that Elliott Hill is going to be taking over. But the fact is that there's probably not going to be an announcement particularly profound taking place between now and November expiration. The most important thing that's going to be going on is, here we are. So if you rolled it into the Novembers, you're going to end up with a trade like this. And the biggest catalyst that we have between now and November expiration is what? The election. They're not going to probably be announcing anything else hugely material. So yes, but that's a good point. Your short an option is essentially worthless. Just cover it, sleep at night. Also bear in mind that, so I've often said that as an option gets up to more than 60 delta. Well, you can also take a look at the put side and give yourself some perspective like that. And yeah, it's 100 deltas. The strike is on the put side, so you could do something like that. Okay. Hi, Mike. Any thoughts on BLK going into? Yeah, so the financials are going to start reporting. Usually when we think about the financials, we think about JP Morgan arguably as the most material one, but let's just take a look at BlackRock and see what the options market's got cooking up here. Okay, so first things first, average move for this thing is pretty small. We've only had a handful of moves that were more than 5% one way or the other by the looks of it. In fact, I only spotted one. Yeah, October of 22, so 2 years ago, they had a pretty good up period then. So one thing about the asset managers, and on the banking side, I think of Morgan Stanley this way, probably more so than, Morgan Stanley and Goldman Sachs used to sort of compete head to head. But Morgan Stanley has done more of an asset management focus of late. When asset prices rise, they're typically beneficiaries. There's a natural flow, net savings going in, retirement accounts and so on. And as asset prices rise, that tends to be good for them because they're collecting a percentage of AUM. And that's going to be true for BlackRock as well. So no reason to suspect that anything's going to be materially amiss with respect to that. So that's the first thing, just to, when you're thinking about it at a high level and you're saying to yourself, okay, how do these guys make money? If most of your money is coming from asset management and you can see the assets that they're managing and they're principally in places like publicly traded equities, and you know that the equity markets are not far off of all-time highs, and definitely we're not during the period that's covered, because this is a trailing period that you're going to take a look at, you're not going to see a whole lot of surprises in terms of their revenues because it's very formulaic, right? So that's the first thing I would say. Unsurprisingly, the stock's going to track along with those prices pretty well additionally. So, and let's take a look here in terms of what the straddles are implying. 960-ish, why not just go to that? Sure. So that's, we'll call it 17 bucks on the call side, 19 bucks on the put side. It's a little more towards the offer versus the closing prices if we want to, or something like that. So not a big implied move at all baked into this. And in fact, are they actually reporting on the next week or the week after? Next week. Yeah, I mean, there's no, it's a nothing burger as far as the options market is concerned. And probably for the reasons I just suggested. Oh, wait a minute. All right. Now let me take a look at we'll just look at the term structure, because this will also help illustrate it. Remember that event variance is going to get baked into this curve. Now this might look extreme, but we're still dealing with 31 vol. That's not what I was just seeing, actually. Let's go back to that. Let's go back to those prices one more time and just make sure I was looking at this correctly. I think that's a little bit high. I don't know. That chart's not right. And the reason, yeah, I mean, it's more like 28 vol, which is only 2.5, 3 clicks higher than the subsequent, so on. And let's just take a look at what 30-day realized volatility is here. Calendar days, we're going to go to trading days. So been as high as 24. Yeah, I mean, I don't think we're in for any really huge surprises as far as BlackRock vol is, and for those reasons, right? So pretty simple formula on how that works. Okay. So FinWest says those ETFs give you all the downside and none of the upside. I don't know. That's not. I don't know. That's entirely fair. They definitely seem to give a significant portion of the downside and not quite as much of the upside for those stocks that are really moving. We saw that in NVIDIA and Netflix. You didn't make as much, and you have a higher tax. You have a higher tax implication. Of course, if you're using a tax-deferred account, maybe that doesn't matter. So, you know, if you're retired and you have a tax-deferred account and you're trying to create yield and you're making regular withdrawals, you know, the distributions are taxed from whatever source derived. So it won't really matter that it's coming to you in the form of yield in that case. But, you know, again, if you're doing this in your own trading account and you have the time to think about it, there's no reason why you can't do these trades yourself, and tailor it more carefully. There are companies that have consistent cash flow, PC says, and are consistently buying back substantial proportions of their shares. AutoZone for some time, and recently PayPal. What are some you like? Well, yeah, so any companies that have significant free cash flow can use those cash flows to buy back their own stock. And one of the interesting things that happens is that if you're looking at EPS growth, you will see, you'll say, oh my goodness, the earnings are always going higher. The earnings per share may be going higher, even if the earnings of the company are not growing anywhere near as quickly. The difference is the accretive effects of those buybacks. But it is safe to say that those buybacks are helpful. The biggest example I think we can imagine is certainly going to be Apple. So let's just take a look at Apple. All right, so cash flow monster. But we can see that over the last couple of years, at least, the revenues have not been growing anywhere as quickly as the EPS has, right? So if you take a look at the top line, you can see that they had peak revenues back in 2022. So that's the fiscal year ended September. We can see that they made just under $100 billion in adjusted net income, and the trailing 12 months, not a hugely different number, right? So this is just about $100 billion. This is, we'll round it up and call that $102 billion. So that's an increase of 2%. But is that how much the EPS grew over that same time frame? Well, no, EPS grew more. And why? Buybacks. So this is just a chart here where we can see their executions, how much they're buying back. Now, one of the things that's kind of interesting here is that the buybacks, for me, in names like Apple, even though it generates such tremendous amounts of free cash flow, aren't as exciting as it once was. And the reason for this is that the scale of the buybacks can remain the same or even grow. But if the company's market capitalization has grown materially more quickly than that, then the accretive effects of those buybacks diminishes as a percentage of the current share. What do I mean by this? So I'm sure a lot of you are following along with this quite clearly. I remember when there was a time when more than 30% of Apple's share price was cash. And the market capitalization of the company was much, much lower. So let's see if we can get back to a time like that, okay? So here we are. Market capitalization 2016, $600 billion. Almost $240 billion in cash, right? So think about that. That means that if you bought the company lock, stock, and barrel for $600 billion, $237.5 billion of that was going to be financed by the company's own stock holdings. Now, there was $87 billion in debt, so you're going to accumulate that, but the net effect was about $150 billion in cash. Well, if you do a $25 billion buyback on a $600 billion stock, that means that effectively you're buying back more than 4% of the company over the course of that buyback period. Now, advance to the present day, and you double the size of the buyback to $50 billion, but the company's market capitalization is $3.5 billion. Well, that $50 billion is a tiny fraction now. It's 1/70th of the current share price. So the accretive effects diminish over time. And I think that's something to pay attention to, that when you see these buyback announcements, understand that the accretive effects of that on your adjusted EPS, or the effective support that it's going to have for the share price, is diminishing because the company's gotten so much larger. So the only way to have an effect that would be similar would be to have a percentage that was also similar. And you can see just how big that would have to be, right? It would have to be well north of $100 billion, which is more than the current free cash flow of the company. So I'm not saying it's not positive, it's just the impact is not as great. So let's take a look at PayPal, which is one of the cases that you just gave. So we can see that the remaining amount of the buyback is $6 billion. This is over an $80 billion market capitalization. So that's huge, right? That's a really 10% of the company would be $8 billion. It's a $6 billion authorization. So that's big. And let's take a look at AutoZone also. So $1.5 billion remaining on a $52 billion market capitalization. So not quite PayPal-esque, but not bad. Not having been prepared for your question, it's a good screening idea. So I'm going to make a note of that, and maybe I'll come up with 5 to 10 names for Monday's live stream. It's a good topic, but I didn't curate a list because, of course, this is live. So I will do that, and maybe Brad or Jay, you guys can remind me. I think it's a good topic. Okay. So FinWest says the YieldMax Gross Expense Ratio is nearly 1%. It's a good do-it-yourself strategy, and thus save the expense. Yeah, 1%. So my the ETF that we were running, we also charged 1%, and I will tell you, it's a funny thing. 1% is a lot if you're an investor, because if your returns are being dragged down by 100 basis points a year, then the returns of the fund need to be pretty good. As it happens, in 2022 and 2023, the fund we were managing outperformed the S&P total return net of fees very handily. However, we didn't make any money doing it. In fact, we actually lost quite a lot of money doing it because there is a sort of there's a high regulatory threshold. It tends to be very data and personnel sort of top heavy, if you will. So it's interesting, it could be lose-lose in some cases. And that was our finding, at least. It's the reason we stopped doing it at the beginning of this year, because although our investment results were very good, our business results were abominable, and it just wasn't an attractive business for us to be in. Which is actually, by the way, something I would point out about ETFs that you invest in. So when you look at ETFs and you're thinking, well, I like this one, I like its risk characteristics and everything else about it, if you say, well, but they're running 150, 200 million bucks, and they're charging 75 basis points or 100 basis points, call it $200 million, and it's 100 basis points, and let's just say it's an all-in fee. So that means that all of their expenses have to be borne by the 2 million. So you have a couple of PMs, you have some risk management because that's required. It's a 40 Act. You have to separate these duties. And you have a custodian that wants to be paid, and let's say that they're taking 25 basis points out of it. That money doesn't go very far. And so as an ETF investor, you can ask yourself, and it's a reasonable question to ask, legitimately, what's the sustainability of this fund? I mean, are these guys going to make, because you might like the strategy, doesn't mean that you can't invest in it for however long it's going to last. But don't expect it to last very long unless the assets in that fund grow to a real size. And if it's a fund that trades options, if they're only trading in the big names where there's a lot of liquidity, that's not an issue. But if they're trading options and they're trading little names where the liquidity might not be that great, and maybe they only have 25, 30 constituents in their portfolio, they're actually really trying to thread the needle, because they have to get big enough that they can sustain themselves as a business, actually running the money, and remain small enough that they don't outsize the markets where they're participating. And that can be a delicate balance. That was not really the case for us, because although our background was in options trading, we were long only and basically just trading, large cap. I think our threshold was on average about $18 billion market capitalization. So you're dealing with pretty big companies in general. Maybe the top 350 names in the S&P would be a representative sample of our investment universe. But it is something to think about as you look at these as you look at these funds. And it's another reason why you might be interested in doing these strategies, buy right strategies, on stocks of your own choosing, because some of them simply might not be that suitable for a fund because the liquidity isn't there. But there's plenty of liquidity for you. So that's an important thing to think about. PC points out AutoZone has bought back 89% of their shares since '98. Yeah. That's it's pretty good. And actually, you can see this here too, because if you take a look at the top line growth and then you take a look at the EPS growth, the adjusted EPS growth over time, you can see what those accretive effects end up looking like. So we'll go back in time here and just take a look at, had you bought a single share and done absolutely nothing, and I don't know how far back my data goes. Maybe it goes back to '98. It does. Okay, good. $1.50. Think about this. So if you bought the stock in 1998, you were making $1.50 a share. Now, obviously, the company has grown tremendously along the way, along the top line. What's the adjusted EPS now, though? And this is just, helps illustrate it. 100 times greater. $150 in adjusted EPS for AutoZone. So, the net effects of a well-managed business, managing the float, buying back shares, the accretive impacts on you as a long-term shareholder can be profound. And I think that's as good a place to end it as any, having chewed up an hour of your time. And it's a great topic. I don't think I've ever done a live stream or just a show talking about companies that have big buyback programs in place and how one should be distinguished from another and whether they actually remain candidates where we can sort of forecast that those buybacks will continue indefinitely. But it's a great topic. It's one we'll talk about next Monday at 4:15 Eastern. Please tune in for that and trade well from now until the end of the week. Thanks for watching.